This is why I don't like IPOs. I got a lot of questions. Every time a big IPO of a known company or everything everyone's familiar with or things that we might have used goes public. And for those who don't know what a public IPO is, it stands for initial public offerings. When a company that has been private, raising seed and series, if you've heard of Series A's to Series D's, they've raised money in the public markets for years. They've expanded, they've built their customer base, they've gotten to a point where it's time to start cashing out. Private investors have probably started maneuvering them to come to public markets so they can reap the return on investment of their years of funding this company's expansion and building up their business back. But the problem with IPOs is this. First, it's always, the buzz is what always gets me. Several of these companies are going to have buzz when they come to the public market for IPOs. For an example, we've seen companies like Uber and Lyft who did great pops on their first days or first couple of weeks of initial public offering, and then they flounder. Like if you look at Lyft and Uber, they're below their initial public offerings from a year ago. And this isn't conducive because of the pandemic. They were floundering beforehand. The problem with IPOs is the deals have already been backloaded. The people who are going to reap the most benefits, at least in the near term, if ever, are the institutional investors or the private investors or hedge funds or private equity funds that were in those seeds and series rounds. When they bring it to public market, you get wrapped up in the emotional buzz. It's, oh, this company's going to run everything and everything like that. But most of these companies are going to miss their benchmarks. And by that, the stats that companies have to go by in the public market are completely different than the private market. For instance, when you're in a private market getting venture funding, no one's checking your books. Yeah, the investors may do a look of how much your burn rate is, basically how much cash you're burning on a monthly or daily basis to keep the company function. That includes administrative, that includes customer acquisition, that includes offices, salaries, all of that. But when you come to the public market, now you have to do when I post those things, so y'all letting you know, earnings seasons, quarterly reports. This is where those companies' books are being vetted by big accounting firms such as Ernst & Young, Deloitte, and all that, when you have to really stand the muster of public perception, that you meet your estimates, did your earnings per share reach what the analyst said it should have been? Are you losing customers? Are you acquiring customers? Or are you still at the same benchmark that you were a quarter ago? And a lot of companies, when they come IPO, it takes a few years to really settle. That's why a lot of companies, especially these tech companies, when they go public, don't offer you dividends because they don't know what their incomes, their cash flows, their debt to earnings ratios are. And that's why I don't particularly like IPOs. And people think, oh, you're going to miss the boat. There's only been a couple of companies that you might have missed the boat when they initially went public. Google is one. People talk about all the time when Google went public, it was a $98 share. Years later, now Google's what, over $1,000. There's a reason that they're called unicorns. They are once in a generation type of companies. If every company was that, we would all be rich. You could buy a penny stock that shoots up when it goes public, and then you'll make your money. That's not how it works. You have to look at these companies' fundamentals. You have to look at their management. You have to look at their competitor advantage. And quiet as it kept, a lot of these companies are one-trick ponies. It's like a music artist who they come up with a good single. You never hear from them again. Like they never make another hit. And some of these companies are like that. There are rare companies that might be able to withstand, coming to public markets and becoming a powerhouse. But most companies, you need to be very vigilant. You need to be very selective because a lot of us have a limited amount of capital that we're trying to appreciate, trying to grow so we can find those next Googles, those next Chipotles, those next Facebooks. So I don't like IPOs unless you can be an investor in the seed rounds where you can write a $10,000 check or a $25,000 check to get that initial ideation off the ground. And if you maneuver your contracts correctly, you can prevent yourself from massive dilution as they raise those series A, B, and C before they come to public offering of an IPO. Then you'll probably make some money. But IPOs are very dangerous. If you are going to get into an IPO, I would rather it not be your main bread and butter. It should be a speculative play that you get into if I lose my money, good. If I gain money, great. But it shouldn't be something that you're always chasing the trends because you're going to get burned. That's why I don't like IPOs.